We will hear India's top CEOs participate in an exciting luncheon panel discussion. And today's topic of discussion is navigating through business cycles. Inviting our esteemed panelists onto stage, our very first panelist was awarded Young Business Leader of the Year at the India Business Awards 2009, organized by the UK Trade and Investment Body. In less than a decade, he has transformed Glenmark Pharmaceuticals from an India-focused branded generics business to an organization which has significant presence across major emerging and developed economies. His vision is to discover, develop, and take to market India's first innovative drug for the entire world. Ladies and gentlemen, please welcome Chairman and Managing Director of Glenmark Pharmaceuticals, Mr. Glenn Saldanha. Good afternoon, sir. Welcome. Please join us. Inviting our next esteemed panelist, a mechanical engineer from Pune University. He obtained a master's degree in manufacturing systems from the University of Warwick and an MBA degree from Harvard Business School. He took charge as managing director of Bajaj Finserv in February of 2008. His role in Bajaj Finserv includes guiding the current businesses and building new ones in the financial services space. Under his leadership, the group companies have grown impressively to make Bajaj Group a powerhouse, catering to the comprehensive bouquet of financial needs of an Indian consumer. Ladies and gentlemen, with us this afternoon, Managing Director, Bajaj Finserv, please welcome Mr. Sanjiv Bajaj. Very good afternoon, sir. Thank you for being here. We now welcome our next esteemed panelist. Ernst & Young recognized him as the Entrepreneur of the Year 2011. Founder Chairman of the Saldanha Motherson Group, he had his first brush with business at the age of 18. Striking a balance between organic and inorganic growth, he has always looked for acquisitions which bring strategic value. A major acquisition was the rearview mirror business from Visiacorp, UK in March 2009. In 2011, the group acquired Peguform, a leading supplier of modules and molded polymer products to the automotive industry in Europe. Ladies and gentlemen, with us this afternoon, Founder Chairman, Motherson Sumi Group. Please put your hands together for Mr. Vivek Chaand Sehgal. We look forward to him joining us in in a short while from now. And finally, joining us on stage, recognized as the pioneer of the retail boom in India, he was voted by Business India as one of the top 50 managers in India who will influence the Indian business scenario in the 21st century. He has been inducted into the World Retail Hall of Fame in the last 2 decades. He has taken Indian retailing to new heights. He has contributed significantly in ushering international brands and modern retailing in the country. He has been with Shoppers Stop since its inception in 1991. From a one-store setup in Mumbai, Shoppers Stop today is India's largest chain of large format department stores. He has been involved in the setting up and operations of India's largest hypermarket, Hypercity. Ladies and gentlemen, with us this afternoon, a loud round of applause as I welcome Vice Chairman, Shoppers Stop. Please welcome Mr. B.S. Nagesh. Good afternoon, sir. And ladies and gentlemen, also with us on stage, he just walked in. Please put your hands together for Founder Chairman, Motherson Sumi Group, Mr. Vivek Chaand Sehgal. Good afternoon, sir. And ladies and gentlemen, television anchor and stocks editor, E.T. Now, a huge round of applause for our panel discussion moderator. Please welcome Mr. Nikunj Dalmia. Requesting Mr. Dalmia to now take over. And ladies and gentlemen, a very pleasant session ahead.
Thank you so much. I'm just going to check with my production that if once they clear me for mics. Good afternoon, ladies and gentlemen. Let me start the panel discussion with a quote I picked up from this lovely book compiled by Mr. Oswal himself. And the quote is from Winston Churchill. Kites always rise highest when they go not with the wind, but against the wind. And true champions are those who can spot stars in the darkness. Exactly 3 years ago, Indian economy was the second fastest growing economy in the world. But now, we are getting twisted from all the ends. We have a sub 6% print on the GDP. We have a broken down currency, high fiscal deficit, structural problem of inflation, a broken down investment cycle, and Indian consumer either is confused or is feeling exhausted. So the question in front of the panel and in front of the House is that how exactly is corporate India planning to survive the storm? With that opening remark, clearly, let me just start with Vivek. Vivek, first identify the headwinds for us, and how are you planning to convert the headwinds into tailwinds?
I think what's very important is the ability of the Indian community per se, because I think in 1947, I think if I'm not wrong, we were close to about 550 different countries becoming India per se. So that has given all us Indians a very powerful capability to get along with a lot of different types of people in different environments and things like that. I think from where I come from, my business, I found that the headwinds that were coming into the government action, inaction, whichever way you want to look at it, allowed us to start thinking that, look, let's start getting out of India. In fact, if you have a look at our 2005 balance sheet, we actually said that by 2010 onwards, we'd be plus 60% outside India. So we started identifying these headwinds much before, and we took the step that we wanted to actually go into different parts of the globe and use the opportunities that they presented because of weaker economies and things like that as opportunities, and started to build up our plants and all that outside.
Mr. Bajaj, you are smiling every time I say slow down because your stock is at an all-time high. You were shaking your head when I'm saying what cycles? Your business is doing well.
Well, you see, the trick is not to look at your stock because if it was at an all-time high in the last week, in 2 days, it went down 10% as well.
You track it closely, that means.
I always track it. All my money is in it. Not that I do anything with it. But answering your question, I think at a larger issue, and one that we all know, but a lot of us don't like to talk about, is that both our current government and our bureaucracy is not working. Now, that's a big problem. And there are certain businesses that have also been part of the problem. The solution for us is to see, in the short term, what do we do for each of our businesses? But in the long term, I think we have a serious problem as a country. And as citizens, it's something that we need to really look at in a serious manner. As far as my own companies are concerned, luckily we are small. So we can choose to grow, but grow profitably. For example, in our lending business in Bajaj Finance, last year, around February, March itself, we started seeing that the external environment could deteriorate. And we tightened our credit policies, and we've still managed to grow 40–50% year on year. But that's because we are still small, so I must say that. What's important to me when I look at the current situation is you need to work with 2 time horizons. We always work with a 3 to 5 year time horizon and an immediate time horizon. Because you can plan for the long term, you make your larger investments more looking at the medium to long term. But you need to navigate day to day by what's happening around you. So it's balancing both these horizons that I think keeps us abreast and luckily allows us to grow in a profitable manner.
So give us an example. How are you taking care of the immediate short term, and how are you planning your long term?
For example, one of our main lines of business again in Bajaj Finance is the retail loans. And we've launched a close-ended plastic card. We have a co-branded credit card as well with one of the large banks. Now, when I look at it from a 3 to 5 year point of view, why shouldn't we have our own credit card? So we have a model that we are evaluating to see, does this make sense or no? We don't have an answer yet. At the same time, if I were to look at June, I wouldn't say for which of our business lines, but for one of our business lines, we stopped doing new loans for the month in 7 cities because we saw some of our credit go beyond our quality metrics. And we put the sales guys into collection and we started again from July. So this is an example of how you're doing two different things with two different time horizons.
We'll get into specifics, but Glenn, first tell us a bit about the environment for the pharma in general, and then in this adverse time, where are opportunities for you?
Well, I think the pharmaceutical industry, if you see the top 5 or 6 Indian companies, they consistently continue to do very well. And primarily because I think the dependence on India per se is very, very low. Most of the top 5, 6, 7 of us, less than 25 to 30% of our business actually comes out of India. So I think the industry has done a good job in diversifying the revenue base. The US is a major driving force for most of the leading Indian companies. And clearly with Obamacare and a lot of shift towards US generics, the opportunity seems pretty exciting. I think, so our industry, the next 3 to 5 years should be very exciting for the leading Indian players going forward.
Mr. Nagesh, how would you characterize the environment for Indian retail? Because I just noticed that you got more gray hair. Is that age, is that wisdom or business stress?
No, I think the photograph is an old photograph. Otherwise, there's no stress because if you look at India as a market, most of the parameters because of which modern retailing got in has not changed. Our area, total land area is not shrinking. Number of people are not coming down. Youngsters are growing. Aspirations are still growing. So I would say if you look at the 3 to 5 year cycle, and that's the minimum that you need to look for, especially brick and mortar retail, this is again one more blip. And if you look at the last blip that we saw in 2007-8, most of us who use that blip as an opportunity have seen some strong results coming up in 2010 and 12. So I see this more as an opportunity. If you ask me, the worry that I have is from the media, okay, because what it is doing every day morning is every day morning really blowing up the situation for the consumer. So when I talk to a consumer, he's saying, I'm really having a ball. Last year I spent 7,000 rupees and bought 3 shirts. Because all of you are panicking, this year gone on sale, so I spent 7,000 and bought 5 shirts. So honestly, the customer is really, really enjoying this whole, the situation that we have gotten in retail. And that's positive because that is getting introduced to modern retail. The other opportunity is modern retail is still about 5%. So there's still 95% of the market open for you to expand. So as long as you don't create a situation to trip on your own shoelace, to me modern retail can continue to grow at 20, 25% year on year for the next 10, 20, 30, 40 years. I don't see a problem.
So how long more do you think the blip could last? Another 2 years, another 3 years?
Very difficult for me to predict. I think people who are predicting are all sitting on that side of the room. But I can tell you that currently it is more because of the sentiments and the withdrawal symptoms which is getting created because of what's happening in terms of possibility of job losses. Yesterday we were talking of job losses, today we say that ITNs have got better offers and everybody has got picked up. So I think it's a mixed reaction that we see in the media. But I would say 4 to 6 quarters for retail, at least from what we are seeing and hearing from our customers.
Vivek, it's often believed that OEM suppliers are the deepest insiders of what's happening to the auto business. First, what is your understanding to what's happening to Indian autos, and then a word on global autos because you also serve them?
Well, I think a lot of people, when they tell me that the automotive business is not doing well and all that, so I've just sort of tried to visualize that he's going to walk to his office the next day because he's not going to use a car. I think there is a limit to what you can postpone to buy a car or a two-wheeler or whatever. So I believe that transportation is a very important part of life. So you could have some aberrations in a particular month, up and down. We don't worry too much about it. Normally we think that car business, you should be looking again to steal this thing from there, 3 to 5 years. I believe the car production, in spite of all the problems that people are saying, are related to a particular OEM in a particular area. But generally, you will see that there is a growth of cars all across the globe. And even in the Lehman crisis here, when the US auto production came down and the car buying had reduced there, It was China and India and Brazil that made up this thing. So the car production numbers per se in any year has not really come down. It's always gone up.
So what is the kind of communication you got from some of your buyers? Are they telling you to take it easy, or are they outsourcing more? Are they confident?
They're saying go for it. We're growing at 40% a year for the last 18 years. So I really don't see why they would tell you to stop. And even if they told me, I wouldn't believe them.
Let me address something which is of immense curiosity here for the entire audience, which is labor problems at Manesar, labor problems at Maruti. Do you think that's a company-specific issue, or labor issues now could really, could really widespread?
Well, I think it's not the first time that a car maker has had a labor problem, so I don't know why we are blowing it out of proportion. I think there is a problem that has happened. We have a lot of influence, especially a company with the size of Maruti, one of the largest car makers in India. You will have these kind of issues. And I think the management has done very well to handle it the way they have under the circumstances. And I think in another matter of a month, 2 months, you'll forget about it. I mean, every big company has gone through it.
So you will expand in Haryana irrespective?
Oh, absolutely.
That's a number, that's a line I was looking for. Mr. Bajaj, the Indian insurance industry in last 5 years has seen a feast and a famine. Now, if I look at the top-down, data, yes, Indians are not insured. There's a great need. But if I look at the regulatory environment, things are challenging. New competition has also emerged. So, in your understanding, what is happening to the insurance sector?
Okay, so firstly, Nikunj, you called Mr. Chaand, Vivek, you called Sanjiv, Mr. Bajaj. I think you got our ages a little wrong over there. Essentially what's happened, if you see in the insurance industry, and it's more in the life industry because of the regulatory changes which played one of the more significant roles. The general insurance industry has been growing 15 to 20% year on year and has been growing well. On the life side, a large amount of business was written through unit-linked policies, and a number of those policies had high commissions. And when the economy slowed down, the stock market came down, policyholders suddenly saw very little value in their policies. And that's why they either withdrew their money after when they could or did not go and buy another policy. Again, when you looked at what they were getting in terms of returns in the initial years, because our commissions in India are all front-loaded. And in different countries it happens in different ways. But when a policyholder sees that versus seeing that he can put money in a fixed deposit and get 9.5% or in gold, and see the stock markets continuing to underperform the last couple of years, it takes his confidence away from those products. When our stock markets were at 20,000, the insurance industry was booming. So the economy and the resultant effect on the stock market does play a very important role. If you see over the last 4 or 5 years, between life and general insurance, and not talking about LIC, but all other companies put together, I still think between 30 and 50,000 crores a year goes into the markets, whether fixed income or equities. The second issue clearly was regulations. We saw significant change in regulations, and I believe many of them were required, but they happened in a very short period of time. Life insurance is a long-term business. If there are going to be changes in regulations, we need enough time to align ourselves with that. The third problem is too many players. We now have 22, 23 players in life and general insurance. Every new player that comes in, how does he build market share? He goes after low-hanging fruit. So he throws capital, pays higher commissions, whichever way he's allowed to, and tries to grab business. We need to see more maturity. I think after a number of players have lost significant amounts of capital, we are now in the last year or two seeing more balanced growth. And that's why the life insurance industry the last 6-7 months now on new business is slowly starting to grow again.
So what kind of industry scenario do you think we could be staring at 3 years down the line? Do you see smaller players, they could really fall out of the business, or we could see M&A activity?
If you look at the top 5-7 players, both life and general, most of them I think are profitable at least on a year-on-year basis. Very few like us are on an accumulated basis profitable, but they will get there in the next couple of years. So I would not be worried about them. The bottom 30-40% are going to be in trouble. They don't have the size, and now they've lost the advantage of paying higher commissions because of the new rules that came out 2 years ago. But the question is, what's the advantage of buying them? People like us, we have a presence in 850 cities and towns. We have one of the largest agency networks. We are growing well other than that short period of 18 months. So there's no benefit to buy, and I think that's where the smaller guys are going to get into a
So I
tough
should
situation.
dismiss all the buzz which I timely pick up that Bajaj Finserv is acquiring a smaller player?
We are excited about growing organically.
Okay, fair point. Glenn, let me address something which is of against immense market curiosity for some of my friends here, the pharma challenge, the patent challenge. How do you think Indian companies are positioned to deal with that?
Well, I think on the patent side, I think, there are two sets of Indian pharma companies, the way I put it, right? There's one group of companies who are primarily focused on various niche segments and trying to build, get into some niche products and build a very diverse revenue base in the US generics space. So those companies clearly will not get impacted by the patent cliff, and I would put Glenmark in that bucket. The second set are the companies who are going after the large blockbuster molecules, right, which are coming off patent, where there are going to be 10, 12, 15 guys, or guys who have some unique exclusivity periods, right? They probably have a 6 months exclusivity on some blockbuster molecules. So the minute the exclusivity expires and there are 10 or 15 guys, the revenue base will fall. Those are the guys who will actually get more impacted by the patent cliff. So there are two sets of Indian companies right now who are targeting different models in the US generic space.
Glenn, in 2008, your company had given a profit warning, and that time also market conditions and global conditions were not all that safe. They were rather sticky. We are again staring at a different environment. But for your company, what are the learnings from 2008, and how exactly are you positioned differently this time?
I think, so if you look at the history of Glenmark, right, from 2000 to 2008, we always had a vision of building Glenmark into an innovative-led pharmaceutical company. That's always been the vision, and that's what got us into doing innovative research in the early years, in the early 2000s. Now, clearly, innovation is a very expensive business, takes a lot of capital to actually work in innovation and to effectively come out with molecules. And from 2000 to 2008, innovation got us to where a lot of the fame, we did a number of deals, got us a lot of cash. While the base business, the generics and the brand generics business was small in terms of contribution, and we were heavily dependent on the innovative milestones. Today, if you look at Glenmark, right, over the last 3-4 years, we've completely changed the model. While we continue to believe innovation is the way to go, we have a very solid generics and brand generics business, very well diversified into several different geographies, which gives the base business a very solid and stable environment. So 2008, we got hit by various different factors as far as the base business, whether it's receivables, whether it's our leveraging. Today, we've corrected a lot of that, and we have a very robust model in terms of the way forward.
Mr. Nagesh, there is a lot of debate whether the retail sector needs a FDI or not. Let's construct two scenarios. First, we get FDI in retail, A, what happens then? B, if we don't get FDI in retail in the next 12 months, what happens then?
I think the one fact is very clear that retail requires capital. The minimum period for a retailer to start making money from a property is between the 3rd and 5th year. So for 2 years, you require a burn. And whether you are a 1-store operation or a 20-store operation, you require a backup to manage the complexities of retail. So you require capital to be able to sustain losses, 3 to 5 years, and you require capital to build for growth. So there is conservative capital to conserve, plus to build, plus to sustain losses. So capital is essential, there's no doubt about it. Now, modern retail is just 4%. Everybody knows that the maximum amount of sourcing the retail does, whether it is modern or traditional, is from the SME sector. Now, at some point of time, the government has to realize that you have to bring in capital. Now, there's not much of capital available for the SME sector in the country. We heard 2 of the CEOs of banking saying that SME is 5% or 7%. So there's absolutely no question that money is not required. FDI is essential, but the impact of FDI in retail takes a 3 to 5 years time. So the question is, if last year this would have gone through, then maybe before the 2014 election, there could have been a scorecard to say we got in 10 billion. Now it looks like that even if it goes through, it will fall into the 2014 and 19 regime. We don't know which regime. So if it doesn't come through, it's not going to shake the world because part of retail is already shaking. If it comes through, you will see the 2015-20 to be a very, very good era for modernizing of current retail, plus supply chain improvements and penetration of the benefits into the SME and therefore into the farm. So I think we need to have that long perspective. The government's perspective are limited to 5 years and the retail perspective has to be 5 to 20 years. I think there's a mismatch. So we have to live with this paradox that we are currently situation.
But at Shoppers Stop currently, what kind of mode you are in? If I take the clock back last 5 years, last 4 years, you were in an expansion mode. Are you now revisiting cost points and pressure points which you have expanded and they don't warrant any economic sense for you?
No, in fact, if you look at it, all the properties that we opened in the last 2 years, the properties we signed in 2007, 8, 9, which we almost got it on a revenue share, okay? And we have seen that expansion. So you open 20 stores on a base of 30 stores. So 20 stores will take 2 more years to start making money. So in the next 2 to 3 years, you'll actually see the return of all the 50 stores coming back. Some of them have cannibalized the existing stores because a lot of growth has come in existing cities. So if you ask me what would be the broad direction, to start looking at again properties, because now you'll get properties which will come out of distressed mall owners, distressed real estate, and some of the retailers who will go bust. So I think this is again the time to start opening up and start signing properties to be ready to take on the market sometime in the next 18 to 24 months down. So broad direction, we are looking for properties, but we will always remain conservative in our growth approach because retail has to go in a cycle of capacity building, capability building, and then after building the capability, build the capacity. Some reason in the last 3 to 5 years, because of the financial institutions, the PEs and the fund managers, I think retailers got a feeling that if you have capacity, and in their opinion, capacity was only money. Everything else happened. I think that is where people have faltered. So I would say, in Shoppers Stop case, capability building has happened. Now we'll build up further capacity. It's a cycle of every 2 to 3 years.
I'm going to ask you a very basic question, Mr. Nagesh, which perhaps is an indicator of the mood. How exactly is the Indian retail customer changing in terms of priorities, in terms of mood, and in terms of preferences?
You will not be able to sweep this with one brush. And probably I'll break this up into 3 or 4 category of customers. Spend on children between 4 to 14 is only coming up and up and up. So, I mean, if you are actually able to target that segment, which is the most complicated segment, I think there's huge opportunity. And therefore, you look at the amount of money being spent on education, toys, which was a very small spend, suddenly you find that toys as a market has come back, games as a market has come back. So I would say 4 to 14, apparel, non-apparel, discretionary, non-discretionary is really positive. Then I would straight go back into 45 to 60-year-old. I think this is a fantastic market which we have in the country. And unfortunately, most brands are missing this. You know, because like you said, you see me gray, but I have money, friend. I can spend, but everybody sees me gray. So I think that's an opportunity because of the way the social systems have changed. Yeah. So that's an opportunity which will still exist. I think the stress has got into the 28 to 36, 28 to 40. Because of the aspirations of the last 4, 5, 6, 7 years, where probably they overbought the house, they advanced the car, upgraded their lifestyle, and also had babies at that time. So the double income has got forced into becoming single income for a period. To me, this is a short-term blip, and most of the businesses in the country have been created for the 28 to 35. So I think there is stress on the business, stress on the consumer. But again, I will see this as one cycle. Because don't forget that the 1991 to 1995 bonds are actually coming into the buying cycle in 2015-20. These are people who don't know the spelling of ration card. They don't know that for Bajaj scooter you have to wait for 20 years. Okay, I mean they ring up and say, Dad, I lost my mobile. I've already bought one. Just tell you before the SMS comes that I've blown up 20,000. So I think this is a generation which is just entering. Wait and watch. 2015, 2020 is going to be very interesting, very interesting.
So when you said 45 to 60, were you pointing at Glenn, me, or all 4 of us?
I think almost all of us. Because it's not only about grey, it's also about not having hair. Right.
Okay, 2011, and you know my question. When you feel that you have over-leveraged, overpaid for your global acquisitions?
Well, I think Motherson per se has always had a very strong balance sheet. Whenever we go on our 5-year plans, and these are always given much before they start. You're paying 40% of your profits out as dividend every year. You're not taking in fresh capital. The only way out for you is to borrow capital. We've taken our particular assets on this thing. We have 3 years' time to pay it all back. We are very comfortable. But the way we present our figures, because we are very, very conservative in our accounting, we actually show as if, because muscle is 51%, 49% is held by the parent company, but muscle shows 100%. So I think once you get deeper into the numbers, you'll find that actually the leverage is hardly any.
So you're not regretting buying $1 billion plus company in 2011?
2011?
3 years ago.
You're talking about Pegaform?
Yes.
No, I think it's one of the fantastic buys that Motherson has. We believe the kind of products that we are into, the customer this thing that we have over there, opens up avenues beyond imagination. And I think the proof is in the eating of the pudding. Within 3 months, we have picked up orders worth 1.3 billion euros. And I think within this year, we'll pick up almost about close to 3.5, 4 billion. So that's a great statement coming from the car makers about the confidence that they have in Motherson picking up Pegaform.
So where is growth coming for you?
See, the growth is not so related to numbers, because I think everybody thinks that, if the car production is going up at 9%, hence Motherson cannot grow more than 9%. And I'm saying no. I mean, everybody forgets that Motherson has a simple policy, and that's called improving the content per car. Plus, the avenues that are open globally, because we've got 138 plants now all over the world. So that opens up tremendous avenues for us. It allows us to piggyback some of our products which are very well known for us in India to global locations. We can introduce, for example, Pegaform is a very German specific this thing, but we are very strong with the Japanese car makers. So we can use that particular thing on the Japanese side. We're already doing that. Same for the Korean car makers. So I think the cross-play is a phenomenal this thing that we have. We have a very clear target that we have given for 2014-15. We will be a $10 billion group by that time. And we have no doubts that we will. In fact, Muscle, $5 billion, we already crossed this year.
When is your finance company going public?
It's not a finance company, it's the holding company of even Motherson Sumi. But it's a shortage of whatever time, that was the only company available, so we put finance there. But it's not a finance company in any way. It only invests, it's actually a core investment company.
It's a holding company. So when
but I don't think golden opportunities come every time. So
which could be 6 months.
Will not happen. No, Motherson has, just for the record, in 18 years, we have not gone to the market.
Okay.
And we came up with SMFL, which the public didn't understand. We were okay with that. We didn't have to. And I don't think within 6 months or 1 year, we're going to come back.
Sanjiv, a word on NBFC business. You've told us what's happening to the insurance industry, but NBFC, the challenge for the NBFC business is that banks who were earlier lending to the corporate sector, suddenly they want pie of the NBFC business. Do you think the NBFC business is getting more and more competitive?
See, there is no business that is only NBFC or only bank. I think this has been a misnomer because of certain successes and failures that we saw over the last decade, where we saw NBFCs essentially becoming monoline, a number of monoline players, whether commercial vehicles or gold companies started doing well. On the other hand, banks have always been diversified. When we started rebuilding Bajaj Finance in 2007, we decided to build a diversified financial services business. And I think today we are one of the only diversified NBFCs. Maybe M&M Finance on the rural side is the other one. Our main competitors are banks in each line of business. Now, a lot of the large private banks moved away from retail financing, retail products in 2007-8 because they lost a lot of money, and they realized that small value loans below 100,000 rupees, take up a huge operating cost, and it's not very easy to make money. Now, few people like us have shown that you can make money, so naturally some banks are coming back. For example, I think HDFC Bank is doing a great job at the way they're going ahead with their retail plans. So you will see smart banks, smart NBFCs come in to each line of business that makes sense. It doesn't mean everybody will succeed. It doesn't mean everybody will get into each line of business. But increasingly, other than a few areas where, for example, if you're doing a loan against shares, banks have a restriction. So the RBI has certain restrictions on banks and certain restrictions on NBFCs on the liability side. But other than that, I think it's open competition.
So within the NBFC business, which is the fastest growing category for you?
For us, the fastest growing category has been our consumer business. And that's a business that we have grown at 60% year on year. But that's also because there is a business with very little competition. That's a business where our average ticket size is 25,000 rupees. And while the return on assets may look nice in a percentage basis, it's 500-600 rupees per loan. So to make that work, the way we leverage technology, the way we've built our risk algorithms over the last 5 years, there's a lot of learning that's gone in there.
It's almost like microfinancing, isn't it?
No, the customer segment is very different. Microfinancing, firstly, when you're talking of loan sizes, you're talking of 5,000 to 10,000 rupees. Plus, you're talking of going to the lowest level of unbanked customers. Here at 25,000, 30,000 rupees, we finance 1 in 4 plasma LCD LED TVs in the country. That's not microfinance, 1 in 4.
What about the NPA cycle in this business?
I think we are personally at the lowest end of our NPA cycle. We had net losses of 0.1%, 10 bips. I would expect on the consumer side for a 40 to 60 bips as being a more steady state. As I said, it's both being part of the cycle, lower competition, and I think our CEO Rajiv Jain is sitting somewhere here, so to his credit for some good things that he and his team have done, we are at the lower end. But 40 to 60 bips is what I would think is steady state.
And for the entire portfolio person?
As far as the entire portfolio is concerned, it would be probably 10, 20 bips lower because the rest of it is SME and commercial, which are low risk.
Glenn, I will talk about specific markets with you. First, what's happening to the US generic market? Opportunity is large, but what we understand is that pricing power is also immense, and so is competition. How are you positioned?
Well, Glenmark, we've always taken a different strategy towards the US market. I mean, we focused on niche segments. And we've done pretty well actually. So dermatology, we are among the, we're probably the only Indian company selling into the US market and among the few that are even outside the US manufacturing. So we have about 18, 19 dermatology products in the US market, which is a main driver for us. The second segment is the oral contraceptive space where we have about 10 approvals where again we are among the leaders there. And we continue to look at various other niche segments. Oncology products will start filing this year, which will actually help us build a sustainable platform, right, to grow the generics business. As you know, we believe that that's the only way you can sustain a generics business, because if you go after the big products, you have a lot of volatility, lots of new players, lots of pricing competition that you regularly face. So we built a very good sustainable model to continue to see consistent growth in the US market, which clearly is a main driver for us going forward.
Which are the new markets which are opening up for you?
Well, I think other than US, we still continue to remain pretty excited about some of the major emerging markets. So you've got Brazil, which is a big market, and we continue to remain excited about Brazil, about Russia. These are the two other big markets, and of course India.
And how exactly generic pricing moving? Because we've seen a random cycle there. Sometimes generic price it stays on, but because of competition, day one, the innovator drug or the patent, really slashes the price down.
Well, it's a competitive environment. I mean, there's no question about it. I mean, every day you see more and more Indian companies who are targeting the US market in the generic space. You have the Chinese players now who have started initiating some filings, although they are still at the very early stages. You will see some Chinese competition going forward. So I mean, the generics business is like running on a treadmill, right? You got to keep at it over and over again just to stay at the same place. So it's a competitive landscape. I think the next 3 to 5 years looks pretty promising for the leading Indian players. Thereafter, one has to consistently think about what next. So whether it's getting into innovation, or it's biosimilars, or so you have to think of the next wave of growth and where that's going to come from if you have to survive and sustain in building a global pharmaceutical company.
Are there any of your business segments or sub-segments where you're witnessing pressure, either pricing pressure or demand pressure?
Well, demand is great. I think consistently we are seeing phenomenal demand coming across the globe for pharmaceuticals, and we're able to penetrate most of the markets. On the pricing front, clearly the biggest challenge, the biggest opportunity and the biggest challenge is the US generics market, right? Because, while once you've built a certain scale, right, you're able to tide over some of the short-term pricing pressures. Every day there's a new player who comes in or who gets an approval, and then again you got to start reacting in terms of pricing. So that's the one market which is consistently a challenge in terms of pricing. But as I said, for the next 3 to 5 years, it looks pretty robust.
I know you don't give a margin guidance, but I'm going to request for one. What could be operating profit margins in the US market? That's the biggest market for you.
Well, again, we don't guide to any specific number, Nikunj, but I mean, the US is extremely
Trajectory up or down?
I think trajectory, if you're focused on niche products and you've got the right product mix, trajectory should be up.
For next 12 months?
I think for the next 3 years, that's all I can say.
Okay. Thank you for that explanation. Mr. Nagesh, in terms of your understanding, are there any clear retail formats which have not worked in India? We all think at the US retail model, and somehow we believe that that can be replicated here. But I'm sure Indian consumer is different.
Yeah, I think what has not worked is the misjudgment in terms of the depth of customer spend. If you look at the last 5 years, the growth has come because a lot of new customers have come in. So to explain it in a simple way, there are many customers who are coming and buying 2,000. If you look at the last year's 2,000, has he moved to 5,000? No. So therefore, we are all depending on the width. What that has done is that we have misjudged therefore the size of the stores. So for the first mistake that almost all players have made is the size of the store. You started hypermarkets with a 75,000 and 100,000 square feet, whereas I think the right size is 45 to 50,000 because the Indian consumer is not started spending on 50 varieties of cheese, he has reached 5 varieties of cheese. If you look at the markets and the product categories have done extremely well, and they will continue to grow as the services. I mean, Indian consumer looks like he's splurging on himself and herself. Look at the number of salons, look at the number of restaurants, look at what's happening on spend in restaurants. So I think on one side, on the service side, the customer is spending very well. On the product side, the customer is conservative, but many more are coming into the new markets. The retailer misjudged the size, and therefore he did overspending in the past 5 years. And like I told you, it will take about 5 years to correct, recorrect, / close down. And that correction is now happening, and a lot of retailers are going through the correction mode. Unfortunately, if you're in the public space or you're in the space where you're funded, most people ask questions about how many stores have you opened, why have you opened the stores, and they keep concentrating on that. And they appreciate people who open stores, but you don't appreciate people who close stores. Because a good retailer is one who's able to take a correct judgment on closing the store, because that's what actually creates the bleed. Because a running store is anyhow giving you like-to-like profitability. So we are going through that cycle. So sizing is one mistake. The second mistake that's happened is we believe that just because we have the money and we can sign stores, automatically the capability of the management will grow up to sustain that. It's a very complex business. You're talking of 40, 50,000 SKUs to be monitored on a day-to-day basis. With a margin, if you're a great retailer, you make 3% PAT, 5% PAT. So I think we have not created a pipeline of management pool and a large team, whether it is as an industry level or at a company level. But companies which have had very stable management have seen blips, but you see long-term their return on capital employed, all the ratios are working very well. So 2 mistakes, sizing, and second is not building capability to manage the capacity.
In terms of pricing or rental, what is your understanding, and how exactly are mall footfalls moving?
See, if you look at the overall mall footfall, it is going positive because of the way the food courts in the cinemas have happened. And in the last 1 year, cinemas, we have seen quite a few blockbusters, so it has helped. But if you look at the rentals, I don't expect the rentals to come down in the good malls. Actually, the pressure will be, it will go up. Because you have malls which are actually planned for construction and getting a long-term yield on the asset. So these are malls who have not sold off the mall, they are retaining it. I think those malls are doing extremely well. So there the pressure of rental will be extremely high. You will actually, once you come for a renewal, you'll find the pressure. Then there are malls who are not doing well. There's nothing called somewhere in between. Either you're doing well or you're not doing well. I mean, those will actually go into NPS. And you'll actually see some of the malls will be taken over by large retailers and redone into department stores or whatever. Some may become education institutions, some may become hospitals. And I've seen both happening in some of the malls. Rentals coming down, not in the near future. Demand is actually much more than the supply. The supply is happening in places where there was already an existing supply. But if you look at the country and look at, let's say, the top 50 cities, and you have about 4 to 10 catchments in every city, you require 500 good located malls. You don't have. Maybe you have just about 80 to 100. But you have another 500 malls which are badly located or in the wrong place or next to where the catchment size is not there. So there are some mismatches between this, which may get corrected over the next 3 to 5 years' time.
So next 12 months, would you be adding more stores? Would you be shutting more stores?
Well, I think we'll be adding more stores. I mean, we had an opportunity to shut a store where the landlord was willing to pay us the next 10 years profit at one go. So we shut and came.
You want to follow the
It was
same
a
policy
profitable
as others?
shutting up.
Yes.
So that worked.
Vivek, if I look at your business profile, large amount of revenues coming from Europe. If I look at the headlines which are coming from Europe, Europe currently is in a recession. Soon it could be in a depression. How are you managing growth in Europe?
Well, I think Europe is a huge term. I think we have to look at my customers. My customers are the Volkswagen Group, Daimler, BMW. They constitute almost about 80%. And believe me, the more you talk about depression, the better it is for the euro, because the euro becomes weaker. The weaker the euro becomes, the more cars they will sell. The more cars they will sell, the more revenues I get.
So you are not getting a feelers from any of your existing customers in Europe as well that they want to cut buying down?
See, again, Europe is too big. I mean, if you say Greece is in trouble, I don't supply anything to Greece. So I'm honestly not affected. I mean, unless on the human side, yes, but business-wise, I'm not. I'm not a very big supplier to the Italian car makers or to the French car makers. So my only concern is the German car makers. And in any case, I think to take a leaf from history, about 120 years ago, there was a chess championship going on. At that time, it happened in the Champs-Élysées. And a world champion of 7 times was lost because he was thinking 10 years, 10 moves ahead, 15 moves ahead. But the guy who won, the guy who beat him, was always thinking of the next best step. I think the kind of circumstances in which we are with countries and continents going into trouble, you have to have your next best step as the next best move. So really, I mean, you tell me what has been able to sustain a strategy over the last 2 years or 3 years? Nothing. But one thing is, if you can react very fast to any problem and challenges that are coming from anywhere in the globe, that's the best strategy. And that's what we feel.
So give us a sense of your top 3 European customers. What kind of commentary, what kind of assurances you've got from them?
For what? What
in terms of future outlook?
They're adding more plants.
Okay.
They're adding more plants in China, Russia, Brazil. We're all there. They're adding more German plants because unlike what people imagine, even Japan is today producing a lot of cars in Japan. The parts may be coming from wherever. So I believe that this particular phenomena that people are going to shut down plants and shift it across, it's not going to happen. And if you are there as a last man standing, then believe me, that much more opportunities come your way because they prefer to have you in their time zone, in their language. They really prefer that.
Which means you're broadly gaining market share from your existing competitors.
Maybe so, maybe so. But we have close to 800 products, so different strategies on different products.
Sanjiv, I'm going to construct a scenario that the FDI limited insurance goes to 49%. Scenario number 2, the FDI limited insurance stays where it is. What happens in scenario number 1? What happens in scenario number 2?
At the industry level or
At
for
the
us?
industry level, and then we'll talk about your company.
At the industry level, first scenario, a lot of money comes in. Second scenario, money doesn't come in. Next level, the top 10 companies makes no difference to their business plans because they are adequately capitalized. Bottom 10 companies, will the foreign partner want to put in money into loss-making companies is a big question. I don't think when we look at the next 2-3 years, the opening up of FDI is going to dramatically change the business. When you look at it long term, the fact that availability of foreign capital goes up, right up to 49% is clearly important. So it's again short term versus the medium term.
In terms of an understanding, so where is the big growth coming for your company? Is it coming from existing metros? Is it coming from new markets? Or are you gaining market share?
It differs from business to business. Life insurance, we are in 850 cities and towns. Over 65% of our new business comes outside the top 30 cities. So we've followed a strategy there to go extremely mass. Because with so many new licenses coming up every year, the lowest hanging fruit is always in the larger cities. And that strategy has worked for us. It's also helped us build the business more profitably. On the other hand, when I look at Bajaj Finance, completely different strategy. Other than our motorcycle financing, we are mass affluent and above in our customer segmentation. So our business all comes from the top 40-50 cities. So the strategy differs by what are the opportunities, where do you want to build your capabilities, which lines do you want to play in, which geographies do you not want to play in.
How are you using the existing downturn to become more leaner, more fitter?
I lost 10 kilos. Across our businesses, we have year-on-year plans to improve productivity, to cut costs. That continues irrespective of whether we are growing or not. And that's why in this period, for example, in the last 3 years, even for our insurance business, we've not had to do any significant layoffs. We've not had to do any significant office closures. We always look at, out of our 1,400 offices, we may change 50 every year, add a few, remove a few. That's because we've always stayed lean. I think that's part of the lineage that comes from the Bajaj Auto days. We are extremely lean even in each of these businesses.
So you're still chasing growth. According to you, and correct me if my understanding is wrong, as of now, you are not witnessing pressure points or some subdued growth in any of your verticals.
Life insurance first quarter new business growth was, I think, 16%. General insurance was at about 18%, and Bajaj Finance was at about 45%. So yes.
Okay, Glenn, ditto question. How are you using the current downturn to your advantage to cut costs, and apart from running from treadmill?
Well, I think the whole rupee dollar situation has benefited the pharma industry quite dramatically. So because we're able to, we're getting that incremental delta because of the dollar appreciation, right? I think the whole industry, most of the leading players, and that was, it contributed quite significantly to the recent quarter. And I think going forward, that's clearly helping the overall business. Besides that, I think, I think the cost structures are pretty well established now in the industry. So I don't think most of the leading Indian players run a pretty tight ship anyway. So in terms of trying to improve on cost structures, there aren't too many avenues to cut cost and bring in more efficiencies. But because we are less impacted by the global downturn, things still continue to be very positive for
Your domestic business is also growing, and it's growing at a run rate which is much higher than the industry average. So what has done the trick for you, and are you confident of your growth?
Well, I think, the domestic market per se has performed well. And at Glenmark, we did a major restructuring last year of our India business, where we relooked at our entire marketing spends, our promotions, our product mix, our portfolio, and we rejigged everything actually in the India business. We also added about 500 sales reps last year, which is actually driving the growth for us in this year. I think for the next few years, you will see sustained growth coming out of Glenmark in the domestic market. The only unknown, of course, is the government pricing policy and some of the changes that are happening in India, both on the pricing policy as well as some of the regulatory changes, right, in terms of getting new product approvals and those kind of things, which could impact growth numbers, not just for Glenmark, but for the industry as a whole.
The minute we say Glenmark, everyone feels okay. A good R&D company, they derive growth from milestone, but it's not simple.
I guess that was the case back in the 2008, prior to 2008. I mean, today we have a very robust business. a fast-growing base business now, right? And we are not really dependent on any R&D milestones, although that still remains an inherent part of our strategy on the R&D side. Having done 6 out-licensing deals, we're pretty confident we can do the 7th, 8th, and 9th in the years to come, right? But that's not a integral, we're not dependent on that extra income or milestones, right, to run the business. Today, virtually every component of our business is cash generating, free cash generating, so it's self-sustaining, the whole model. The generics and brand generics business also is free cash generating. So I think the dependence on R&D milestones has diminished very, very significantly. And clearly now the next step for us is to continue getting scale on the generics and the branded generics business, and to use research as to get the next big upside in terms of actually bringing something to market someday. And that's what we're working for.
You know, a week ago when I interacted with you on the 18-hour forum, when I asked you on a milestone guidance, you said, look, we don't give a guidance. So let me rephrase my question. This is FY13 for FY15. How much of your total revenue will come from milestone?
Well, I
That's
can't
a fair
guide
question.
to that.
That's a fair question.
I mean, clearly we won't put out a number on any milestones, you know, and
Every CEO has an internal number.
I'm sure we do, but it's very hard to publicly state it.
Let's try and go close to that.
Because, you know, the challenges are too many, right? It's extremely unpredictable, right? The whole research game itself is extremely unpredictable, and we've learned that the hard way. We've gone through it. We've been doing this for 12 years. We've put our hearts and soul into it, and we've seen quite a lot of success. We've got $200 million of cash by out-licensing molecules so far. And all I can say is that trend will continue going forward. Now, whether it happens this year or next year, the year after that, it's very hard to predict. But our licensing model still continues to remain an integral part to our business model and to what will help transform us.
Since you cannot predict our licensing, I'm sure you can predict the other lines of business. At what rate do you think your other lines of business will grow at?
Well, I think, you know, a 25+% CAGR over a 3-year period is pretty much where we should be going forward.
We know that. Come on, give us something more. You're already down 1 quarter, so I'm sure you'll be 25.
Well, again, we can't go anywhere beyond that, Nikuj, right, in terms of growth.
Okay, fair point. Mr. Nagesh, what do you make of the M&A activity which is happening in the retail sector? Just one-off, 2-3 deals what we've seen, or this is just the beginning?
No, I think this is just a one-off. You won't find too many of them. Either there are 3 or 4 good players and they are too large and they are all family-owned organizations. And in India, I don't see family-owned organizations at this early stage either buying or selling. Okay, everybody would want to buy irrespective of whether he's in a sale position. So I don't think that happening. And the smaller ones are mostly PE funded, and like Chanda was saying, some places the asset quality has gone so bad that you won't buy. And the last thing is somewhere this whole feeling that FDI comes and gives you top dollars and they pay you double the amount and buys out defunct companies, all a myth. I mean, either they will take your pants off and buy you, or if you're damn good, why would you want to sell? So I think those situations are a little early in Indian modern retail. I don't see too many M&A activities happening.
Let me ask you a broader question, Mr. Nagesh. In 2002, when the Indian retail industry started, everyone thought the Kirana man at the round of his street will be replaced. That man has not gone, but the retailers have gone.
Yeah, absolutely.
Why is that happening?
That will happen for the next 30 years, 50 years. I think 2 or 3 things. One is if you look at the real estate development of the 40 million houses being completed and being given delivery has not happened. So where are we staying? I and you are still staying in places where there is no space to even create a 2,000 square feet Kirana, forget a 5,000 square feet supermarket. So there is no infrastructure available. And second is with the traffic condition in most of the cities. I mean, there's no way you can go to a supermarket in 10 minutes or 20 minutes and come back. So you are doing your top-ups only from Kiranas, and you're doing your bulk purchases on monthly basis from the supermarkets and hypermarkets. So Kiranas will survive. And they will also survive because they don't have a corporate cost. They are extremely nimble. Every strategy in the modern retail the CEO makes, okay, by the time it reaches his head office store, the store next to his location, the whole street has already adopted the strategy. They've gone and bought up his loss-making item first day and sold it off to the customer by making profit. So I think we are talking of a of a front-end guy who's very smart. The good model that you'll see emerging over the next few years is a corporate back-end retailer operating with a front-end entrepreneurial Indian kirana shop. Because we have not reached a stage where we are able to develop our front-end shop managers into such smart cookies to do the same work that a kirana guy does. So if we think we are doing it, we are fooling ourselves. There's a long, long way to go, especially competing against the kiranas or the small stores.
Since we are almost about to end this session, I'm going to keep my last round constant with everyone. Vivek, what is giving you sleepless nights, and in the next 3 years, what is the best case scenario for your company? And the worst case scenario as well?
Well, sleepless night must be the flights I take, but I think nothing really bothers me which doesn't bother other people, and I think that's good because there is an uncertainty, keeps you on the toes, but as a business outlook, even in the last quarter where supposedly India is in trouble and everything, we have grown 41% domestic and 176% globally. So that's not an area of issue. We are very clear that 2014-15, where our targets are, we will be very close to that. We believe that, thanks to Nagesh, he was just talking about the traffic conditions. We don't apologize for that. We feel good. More cars, more better for us. We believe that transportation is a necessity. It's beyond any other area of however you want to classify it. So we believe that transportation is going to do well, and as long as that's doing well, we have nothing to worry about.
Ditto question to you as well, Sanjiv.
Well, I don't know about sleepless nights, but I'm definitely having a hungry afternoon right now, especially watching 300 people eat over here while we are all hungry. No, luckily no sleepless nights. Without being immodest, I think our businesses have done well. But we are in the insurance business, which is about long-term promise. We are in the lending business, which is about giving out money. It's tougher to collect money. So I think just keeping our nose on the grounds day in and day out and growing steadily with quality is what we try to do all the time.
You know how to pop a pill if you have sleepless nights, don't you?
Sorry.
You never have sleepless nights. I'm saying, when you have sleepless nights, I know you know the right pill to pop. So what is giving you sleepless nights?
I mean, I think for the pharma industry, the biggest challenge, if you ask me, is compliance, right? Making sure you stay out of trouble in terms of FDA compliance issues, right? So I think a bulk of senior management time has to be spent in that aspect, right? To make sure they stay out of trouble in terms of FDA compliance. So I guess that's the one potential risk for any of the leading pharma companies which exists, right? Other than that, I think growth is, is pretty much there, right? Most of the companies, you will see very strong growth, you will see very strong performance, profitability is good. So I think overall, as long as we stay out of trouble in terms of compliance, right, I think you will see a very robust industry evolve, right, over the next 3 to 5 years.
So Nagesh, closing comments from you.
Very, very positive about the Indian consumer over a long-term period. On the retail industry, I think it will continue to grow with absolutely no fear for the small kirana retailers. I think retailers are not having sleepless nights because they generally party with the consumers to understand them better, but they do get early morning shocks because of the changes in policies, because retail is, FDI you talk at the central level, but almost all policies are made at the state level or the corporation level. I think that's the, the cushion that you have to build in order to sustain this. But mid to long term, I'm not seeing a huge fallback or a negative.
The panel here is not having sleepless nights, but I expect some of you to have a sleepless night because we will be repeating the show tonight on ET Now. So I expect some of you to tune in, watch the show at late at night, and tomorrow morning when you come to work, maybe a little bit of sleepless night. Ladies and gentlemen, let's put hands together for this lovely panel discussion. I guess we've got an important message for all of them, that in times of adversity, the champions truly shine. And with that, let me hand it back to the MC.
Well, thank you so much. What a very, very interesting panel discussion. Perfect combination of nourishment for mind and body. Thank you very much, gentlemen. And to do us the honors, I request Mr. Ramdev Agrawal to please join us on stage and present a memento to each one of our panelists. Ladies and gentlemen, we thank Mr. Vivek Chaand Sehgal, Founder Chairman, Motherson Sumi Group, A loud round of applause, please. Join us in thanking each one of our esteemed panelists. Thank you very much, Mr. Sanjiv Bajaj, Managing Director, Bajaj Finserv. A special memento and a beautiful bouquet of flowers for you as well. Ladies and gentlemen, a loud round of applause. Our moderator of this panel discussion, Mr. Nikunj Dalmia. We'd like to thank the Chairman and Managing Director at Glenmark Pharmaceuticals, Mr. Glenn Saldanha. And join us in thanking Mr. B.S. Nagesh, Vice Chairman at Shoppers Stop. Thank you very much, gentlemen, for your presence here this afternoon. Thank you.